Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, we're going to take a look at the investment merits of AmerisourceBergen, one of the leading medical distributors and drug wholesalers in the country. And what I've got on the graph right now, I've simply got adjusted operating earnings, which is the orange line, plotted year by year going back to 2000. The light green shaded area are future estimates. The dark green are actuals. What I want you to see, one reason I consider this, and I even referenced it as an almost perfect dividend growth stock, is I want you to see how consistently this company has performed historically. During this time frame, earnings growth has averaged 14.6%. That's roughly, almost double what the average company does or what the market has done. So the company has generated a great record of growing earnings. Now, the next thing I'm going to do, I'm going to add dividends and take a look at the dividend payout ratio. So this is a plotting of dividends since they initiated one in 2002. They froze the dividend for the first couple of years, and then they've had about 14 years of dividend increases, averaging almost 30%. I'll show you that in more detail in a moment. So you see the payout ratio was very low here in the 2, 3, 4%, and more recently they've been paying out about 25% of their earnings. Now, when they pay them out, we plot them on top of the orange line. So this is when the dividends belong to the company, and this is after they've been paid out, because your total return is going to be a function of the stock price going from point A to point B plus whatever dividends that the company pays you. So now I'm going to add monthly closing stock prices to the graph, and what I want you to see, as you always do, is that there's a very high correlation between what the company's business results are and the company's stock price. And in simple terms, the orange line here represents fair value based on a multiple of earnings. In this case, we're looking at 15 times earnings. So anywhere you would touch this orange line, it would represent a PE of 15. So I've got that as a valuation reference, and you can see that the price tracks that, and when the price gets above the orange line, as it always does, it comes back to it. When it gets below the orange line, it comes back to it, and so on and so forth. And right now, the stock price is below the orange line, which tells me that the stock is fairly valued. Now, this is a formula using a discounted cash flow formula of trying to determine the intrinsic value. It's really an earnings yield of about 6.67%, which is considered fair value or attractive. The next line I'm going to add here, I'm going to add what we call the normal PE ratio, which is really kind of a best fit line. And this line turns out to be, for this long-term view, about 16.8. So what you're seeing here is roughly a range of valuation that this company historically traded at based on earnings. And again, the point is the stock is significantly undervalued. Now, just briefly before I go on, if this stock were to go to fair value by year-end 2021, you'd be averaging about 20% a year. And that's one reason why I think it's attractive, because the current PE is 12. Earnings right now are sitting at about $1.60 plus, growth. So if it does grow to $6.85 and all the way to $8, then you're buying earnings today at 12 times earnings that you would eventually be capitalizing a much larger amount of earnings at a PE of around 15. And now, if this were to go up to its, recent historical normal PE, you could make up to 25%. Those are simply what-if scenarios. The point is the stock is undervalued. The company is still growing, but I want to point something out. The historical growth has been 14.6. If I shorten the time frame, we're down to 12.6. And if I even shorten the time frame some more, you'll see that the growth rate has been down to about 8%. Now that becomes important, because when I go into forecasting here, if I look at the 3 to 5 year forecasting growth rate, it's expected to grow at about 7.3%, which is consistent with what recent historical norms have been. If I look at specific estimates for the next 3 years out to 2021, and that's as far as I want to go, I want you to notice down here that you've got 18 analysts forecasting $6.85 for 2019. And by the way, that's right in line with company's guidance as I put in the written portion. And then you've got 18 analysts forecasting $7.39 for the fiscal year ending September of 2020. And then we lose some analysts here. We're down to 11 analysts that's looking at $8.01 by 2021. So, if this were to happen and if it were to trade at this valuation, we'd be able to generate about a 20% rate of return. If you use the same estimates and apply that normal PE valuation, and these numbers become really attractive, over 25% out to 2021. The point is, it's a very undervalued stock. stock that provides the opportunity to continue to grow and get PE ratio expansion. Now, I'm going to go to this historical compound annual growth rate graph because this is a graph that is using historical growth instead of analyst estimates. And again, I'm going to pick the more recent growth here so that, we're coming up with a realistic number. And I've got, double-digit returns, very similar to what I did with the specific numbers. The point is, this is capable of generating something around 15 to 20%. Reason I went to this graph, I want you to notice that I'm looking at all the historical growth rates. These are with no estimate data included. And you can see this company's consistently grown in the double-digit rates, and more recently it slowed down. And I do think it's practical to consider that its growth is going to slow down going forward. But nevertheless, when you look at this company from a standpoint of current valuation relative to its earnings generation capability, it looks like a very undervalued stock. But now I always like to look at these things using a lot of metrics. The PE ratio of times earnings is good, but let's take a look at diluted earnings, because diluted earnings tell me a story here that you don't see with the operating earnings, and that is you've got some accounting convention here. This company's made a couple of big acquisitions, and as a result, their diluted earnings in 2015 were actually negative. Their diluted earnings were also very low in 2017. It went from $6 in 2016 to about $1.60 in 2017. But here's something, the reason I want to show you this, because I look at diluted earnings to give me some indication of how the company does. Because here you've got accounting convention. You've got, one-time charges, non-recurring charges, non-cash charges, etc. But when I put price on the graph, I want you to notice that even though their diluted earnings were falling dramatically, it's one reason I don't like to value stocks using diluted earnings, their price actually was spectacular. It rose spectacularly during this period of time. Now, the reason for that is because investors tend to look past things like accounting convention and look at how the business is actually performing, which we saw with operating earnings, but we still didn't explain this big surge in price. That's because operating cash flows dramatically increased. Now, when I'm looking at operating cash flows, price isn't as important to me either most of the time with a dividend paying stock. What I'm really looking at is my dividend being covered by the cash flows. In the case of AmerisourceBergen, you can clearly see that the dividends are well covered. Now, if I move on to free cash flow, which is the money left over after spending the money it takes to run the business, again, this gives me a comfort. Is the dividend safe and is it well covered? Free cash flow also covers dividends. But once again, we see this rise in price really correlates pretty well to the free cash flow number. And then finally, I'm going to go to EBITDA, which is really a form of sales, earnings before interest, taxes, depreciation, and amortization. And I'm going to get another valuation reference with this. And once again, I see that, I've got this high correlation to EBITDA and price. I see the stock being undervalued. And if I base my calculations on EBITDA, I've got a 14 or 15% rate of return going forward. And if I go back to my forecasting graphs here and look at, my EBITDA values, I've got very similar to what we saw with looking at operating earnings. Again, slightly different calculations because we got different numbers here. But another thing that I want to basically make a point is the adjusted earnings number is the one that's talked about most. It's the one that's reported most. If you go into any other websites and look at what earnings results are, you're going to see that they're actually talking about adjusted operating earnings. Now, the forecasts, again, for the current year are for $6.85. The company's guidance is between, I think I wrote it in the article, it's about $6.75 to $6.90. So that number's right in the middle there of what the company's actually guiding. I think $6.70 to $6.90. We're showing the consensus at $6.85. Guidance has a great deal to do with what the analysts are forecasting. So one of the things I want to do when I'm looking at these forecasting graphs, this is my starting point before I do really comprehensive due diligence. So let's see how good the analysts have been when they were making a forecast 1 year in advance and when they were making a forecast 2 years in advance. Now, the summary tells us that on the 1-year forecast, the company met estimates 80% of the time and beat them 20% of the time with a 10% margin of error. Giving a little bigger margin for error for forecasting 2 years in advance, the company beat analyst estimates by 100% with a 20% margin of error. And you can see that in the details where, you had these little meets and beats that were pretty close to what the analysts were saying. Now, what does that mean? That tells me two things. One is that the company guides analysts pretty effectively, at least they have historically, but it also tells me that this company is relatively straightforward to estimate earnings on. So I'm starting out here with a really good feeling about analyst estimates and whether or not these estimates are real. So I put some pretty heavy credibility in these estimate data. Estimates change or are different for different companies. In this case, we've got really a good estimate record. Now from there, I'm going to move into fund graphs, which is financial underlying number. And I'm going to take a look at some other metrics here. I'm going to look at the company's balance sheet, and I talked about that a little bit in the written portion. The company's balance sheet is very, very healthy, in my opinion. Their assets or growth has been strong. Their cash and cash equivalents are healthy. The company does have some debt, as I talked about, but it has an A- credit rating. We also talked about their cash flows quite a bit. I'm not going to reiterate that. And we can also take a look at their income statement. And again, not going to reiterate that. Maybe perhaps the only thing that I might want to show you here, just for sake of brevity in this thing, is the fact that, the company has generated very strong revenue growth historically. And, revenue growth has been really kind of the bottom line. Now, that actually is important to me because although the company does generate good revenues, one negative that I think you might want to consider here is this company, and it's typical for the industry, does not necessarily generate great growth and net profit margins. If you look at the bottom of the graph here, I'm going to shorten this just for the last 10 years or so, you can see that their gross margins have been in the 2 and 3% range, and their net margins have been actually below 1%. They get, high up to almost 1%. Last year, there was about 0.99%. So the company is a very thin margin company. It's analogous to a grocery store. It's drug formularies, but they do an enormous amount of business. So that's really critical. Another issue that I want to talk about, I want to go into the in millions graph and look at common shares outstanding. Now, as a point of fact, I like to see a company issuing shares when the stock valuation is high, and I only like to see them buying back shares when the valuations are low. And what you'll notice here is if you look at 2000, let me shorten this again to the last 10 years, the company maintained their share count pretty well. They did slightly, it had a negative growth rate of 4%, 3.8%. But they were generally keeping their share count pretty consistent when their stock was overvalued. And when it was really highly valued, they did issue some shares. But I'm not real happy with how management has handled share buybacks here. That's one thing that I look at with a little bit of a jaundiced eye. There is no such thing as a perfect stock. So I don't mind the company buying back stock when the price is cheap, but I don't like them buying back stock when the price is high. But even in 2013, 14, and 15, the company was reasonably fairly valued. And back in 13 and 14, when they were issuing some shares, was when the valuation was really high, and that was pretty good stewardship. So I'm going to give them about a B on handling share buybacks. Now, just to conclude this video, a couple other real quick shots. I'm going to look at price to sales. I could have also shown you this in fund graphs. They're trading at one of the lowest price to sales the company has ever traded at. As I mentioned, revenues and sales have been, real strong. The company's available at a very high earnings yield right now. Almost any way you measure this stock, it looks attractive. The risk would be politics. If there's really a massive change in how healthcare is delivered, it could affect companies like AmerisourceBergen. But regardless, as I said in the written portion of the article, there's still going to have to be distribution, and it's still going to go through companies like Amerisource and the pharmacies like Walgreens and CVS, etc. And as I also mentioned, there is a speculative appeal to this stock, and that is the fact that Walgreens Boots Alliance, they've recently negotiated a pretty attractive deal for both companies, I might add. But Walgreens does have about a quarter interest in this company, 27% to be exact. And there has been some scuttlebutt by a Raymond James analyst that Walgreens may buy out the whole company. Well, this would be a great time to buy them if I was Walgreens, because they're going to have to bid something above current market value, and they've got some really good room here to where they could, create a bid significantly higher than its current market price and still be buying this company at a reasonable reasonable valuation relative to historical norms. That would be a kicker. That's a speculation. That if that happens, it's kind of good news, bad news. You'd make some short-term money, but you'd also lose the long-term opportunity. And if it doesn't happen, as I've tried to point out throughout this video, I think AmerisourceBergen is an excellent investment. It's a total return investment. It offers a 2% current dividend yield, which is just slightly below the market. But if you look at long-term performance of this company, it's been exceptionally outperformed the S&P 500 in every metric, and it's significantly outperformed it in dividend income, even though it's only been paying a dividend since 2002, and the dividend growth rate has been exceptional. I also want to kind of close by pointing out, if you remember when I showed you the cash flows and how high the cash flows were in 2015 and 2017, 16 and 17, I should say, you can see that these were all times, and even prior to that, where the company, when the cash flows were high, even going back to 2010, the company increased their dividend dramatically. Now, I don't see those kind of increases happening again, because they went from a very low payout ratio to a low payout ratio now to what I'll call a moderate. But having said that, there's also still room for the payout ratio to increase if the growth does slow down a little bit. So as a dividend growth stock, I really like AmerisourceBergen here. Anyway, this has been Chuck Carnevale saying thanks for watching. If you liked what you saw here, don't forget to subscribe to our YouTube channel, and I look forward to talking to you again very soon. I'll be covering several dividend growth stocks for total return, and this is the first of a series of articles where I'll be looking at attractively valued dividend growth stocks. Thanks again.